The housing market is building a silent storm, and most people don't even see it coming. While all the headlines are screaming about all-time high asset prices, there's this really strange tension brewing just beneath the surface. You've got a record number of homes hitting the market in some places, but at the same time, sales are slowing to a crawl. And all of this is happening under the weight of the highest borrowing costs we've seen in a generation. So this leads to a pretty critical question. We're all kind of conditioned to look for a repeat of 2008, a loud, obvious, spectacular collapse. But what if this time is different? What if the market isn't going to scream but whisper? What if the crash isn't some big single event, but a slow, creeping stall that's already started? Let's dig into the data and see what it tells us. Okay, so on the surface, everything looks fantastic, right? Especially for homeowners. According to Zillow, U.S. home values have shot up a mind-blowing 45.3% since just before the pandemic. Now, to put that into perspective, home values historically grow about 4% a year. So we've basically crammed over a decade of normal price growth into just 5 years. So what's the problem? Well, this is the problem. While home prices were going to the moon, the cost to actually borrow money to buy one exploded too. The average 30-year fixed mortgage rate has more than doubled, jumping from under 3% back in 2021 to nearly 7% today. For anyone trying to buy a house, this has completely changed the math, pushing monthly payments into the stratosphere and basically choking off demand. And here is where it gets really weird and confusing. You'd think with costs this high, nobody would be selling their house. But in some parts of the country, the exact opposite is happening. Data from Realtor.com shows that in the West, for example, the number of homes for sale has surged by over 40% in just 1 year. So let's get this straight. We have sky-high prices, punishingly high rates, and a flood of inventory in certain areas. These pieces just don't seem to fit together. All right, let's make sense of this puzzle. To really understand what's going on, here's how we're going to break it down. First, we'll look at this silent storm that's brewing. Then we'll dive into the great affordability squeeze. After that, we're going to unpack the paradox of supply, talk about what a slow crash could look like, and finally, get into how you can navigate this completely new market. Okay, let's start with the central conflict, the main paradox here. We've got more homes coming onto the market, which should be great news for buyers, right? But because prices and mortgage rates are so brutal, fewer and fewer people can actually afford to buy them. This is creating a massive logjam in the system. Basic economics Econ 101 tells us that more supply should mean lower prices. Simple. But that is just not what we're seeing across the country. Prices are staying stubbornly high, even as more for sale signs pop up. It's a paradox that shows the market is fundamentally strained, stuck between sellers who are dreaming of yesterday's prices and buyers who simply cannot afford today's payments. And this brings us right to the first huge indicator of this silent crash. The affordability crisis is really reaching a breaking point. This isn't just about houses being expensive anymore. We're talking about a massive, widening canyon between what people earn and what it actually costs to own a home. Let's just put some numbers on this. We already saw that home values shot up over 45% in 5 years. Now, during that same time, sure, wages went up, but not even in the same ballpark. They haven't come anywhere close to keeping up. And this disconnect is the absolute core of the problem. Housing became a runaway train that just left everyone's paychecks standing at the station. And this is the result. This is what it looks like in the real world. According to the National Association of Home Builders, a jaw-dropping 76.4 million U.S. households, that's 57% of the entire country, cannot afford a home priced at just $300,000. Just let that sink in. The American dream of homeownership is now mathematically out of reach for the majority of the population. That is simply not sustainable. And this quote reveals another critical layer of the problem. It's not just about the total number of houses for sale, it's about having the right kind of houses. Basically, what this report is saying is that even with more homes hitting the market, they're not the starter homes that average families can actually afford. There's a giant hole where the affordable houses are supposed to be. Okay, so let's move on to our second indicator, because this is where the picture of supply gets really complicated. On the one hand, you hear everywhere that there's a massive national housing shortage. But on the other hand, we see inventory just piling up in certain cities. And the crazy thing is, both are true. This contradiction is absolutely key to understanding what's going on. First, let's talk about why the supply of existing homes is so tight in so many places. It comes down to something economists call the lock-in effect. Think about it like this. Nearly half of all homeowners out there have a mortgage with an interest rate of 3.5% or even lower. They basically won the lottery. Why on earth would they sell their home and give up that incredible rate only to buy a new one at nearly 7%? The answer is they won't, and this is keeping millions of homes off the market. So you take that lock-in effect and you combine it with years and years of not building enough houses after the 2008 crash, and you get a massive structural hole in the market. According to Freddie Mac, the US is short about 3.7 million homes. This national shortage is the main reason why we haven't seen a massive nationwide price collapse. It's putting a floor under the market, at least for now. And yet, look at this. This shows the paradox perfectly. While the nation as a whole is short on housing, you zoom into specific markets that boomed during the pandemic, and they are now flooded with inventory. In Denver, the number of active listings has literally doubled compared to before the pandemic. In Austin, they're up almost 70%. It's creating a tale of two housing markets, where some places might face serious corrections while others stay tight. So, what's the bottom line? What does all this mean for the future? We've got this messy cocktail of an affordability crisis, a national shortage, and these regional floods of inventory. This isn't leading to a big 2008-style explosion. No, it's leading to something very different. A prolonged market stall, what you might call a slow crash. Now, it is absolutely essential to understand that 2025 is not 2008. The 2008 crash was caused by systemic rot. You had risky subprime loans and banks that were leveraged to the hilt. Today, the situation is different. Lending standards are way stricter and homeowner equity is at historic highs. The problem today isn't bad loans. It's that good, qualified borrowers simply cannot afford the price of admission. This quote from an economist at Capital Economics really captures the forecast perfectly. Notice his words. He's not talking about a sudden collapse. He's talking about a sustained downturn. He says the market is buckling under the weight of high rates. This is a slow grind, not a sudden snap. The pressure is just building, and prices are finally starting to bend. So what can we realistically expect? Well, instead of a big nationwide crash, we'll probably see a mix of things. A small price dip on the national level. Much bigger price corrections in those overbuilt markets in the South and West. You're going to see builders offering all kinds of incentives to get buyers in the door. But most of all, you're going to see a market logjam, where sales just stay slow because buyers can't make the math work and sellers don't want to. Okay, I know this is a complex picture, so let's translate all of this data into a clear, actionable strategy. Because whether you're thinking about buying, selling, or investing, understanding these new rules of the game is absolutely critical for making smart decisions. So, if you're a buyer, stop paying attention to the national headlines. They are misleading and irrelevant to you. Focus like a laser on your specific zip code. Is inventory rising there? Are you seeing more price cuts? That's your signal. For sellers, the party's over. You have to price your home for today's market, not last year's fantasy market. Waiting for a rebound could be a huge mistake. And for investors, this is not the time for big risks and easy flips. A market stall means a property can sit for a long, long time, and that creates massive risks if you're overleveraged. So, to bring it all home, we're not in a 2008 moment where the whole system is screaming in terror. The change that's happening right now is much more subtle. It's a quiet, data-driven shift. The market isn't shouting that it's in trouble. It's whispering warnings. And you can hear them in the affordability numbers, the inventory levels, and the sales data. All the signs of this slow crash are there if you know where to look. They're in the local listing data, they're in the mortgage application numbers, and they're in that growing gap between what people earn and what houses cost. The great housing boom has given way to the great housing stall. So the big question is, are you positioned to hear what the market is trying to tell you?